Welcome to Ben's Market Insights. It's episode 16, and we're going to talk about the potential new head of the Fed that's being discussed by Trump, or a chap called Kevin Hassett. We're going to talk about the Fed's two favorite signals for the economy, and we are also going to be discussing what happens to the dollar and interest rates with the FOMC, i.e. the Fed, making their decision this coming Wednesday. Let's talk about Kevin Hassett. He's the current front runner. He's also the current head of the National Economic Council. He's worked with likes of Mitt Romney and John McCain, so he's a true conservative. Those two characters have been on the other end of Trump's ire in the past, so it's interesting to see that Kevin Hassett has been certainly publicly Trump apologist and an acolyte, and that would imply that if he were to become head of the Fed, the interest rate positioning would be quite dovish, obviously implying that the rest of the committee would follow through as well. That, for me, is if it were a central feature, would imply that there is a very expansive strategy heading into 2026, that interest rates will fall below where most pundits would suggest the right and fair interest rate should be. And that could imply even rates coming below or falling below 3%, implying negative real interest rates. That is very significant because it implies more liquidity into risk assets. It implies better performance of equities over bonds, and that is not something I think that is consensus going into 26, but I think that it is very much a feature of what we're going to see, particularly keeping in mind that the Republicans are behind the curve at the moment when it comes to the midterm elections in November of next year and need to put their foot on the accelerator to get their support back up and running. The best way they can do that is by channeling liquidity into the economy. So we've not had official unemployment data from the government, but we've had ADP data, which would suggest that employment in the US is softening. I would take that as a temporary feature, particularly coming back to the point that if we do see an expansive economy in the first half, we'll probably start to see a re-employment coming back again. And the Fed's favorite signal in terms of inflation is something called the PCE core indicator. And that is lingering around the 2.8%, which is still in safe harbor territory. It's not down to the 2% target that they've got in mind, but it's also not exceeding the 3%. I'll come back to this point in a minute, but I believe that come the second half of 2026, that inflationary pressure may well start to kick in and push well past 3%. And that would put the second half of 26 into a very different outlook to the first half. The other thing that's very interesting at this juncture, and not surprisingly given this expectation of lower rates and an expansive economy, is that the Fed also looks at what is a relationship between the 2-year Treasury yield and 3-month Treasury yield. The difference has in the last 2 years been negative, and the negative number implies a contractionary economy. That means that the signals were suggesting that the economy could still fall into a recessionary environment. That has now turned positive. And it's very indicative of, despite whatever investors or pundits are suggesting, that we actually do have in front of us, at least for the first 3 to 6 months, a growing economy and potentially growing faster than what the market is expecting right now. Now, a corollary of having lower rates is clearly having a weaker currency. So you should expect that the US dollar, which has been weak in 2025, is likely to continue that going into 26. The other aspect of that is that there is an inverse relationship between a weak US dollar and strong commodities and strong gold prices, as well as an improving performance in global emerging markets. Now, let's start moving towards the micro discussion And just to put that into context, global emerging markets account for roughly 5 to 10% of a global asset allocation at this juncture. You also have commodities accounting for anything around 2 to 3% of a global asset allocation, and gold 3 to 5%. Everything I'm about to say now would suggest that the allocation to each one of those asset classes should probably be at the top end of that going into 26 and even higher. And the reason is largely because if we are seeing US interest rates falling at pace, which I think will be the case, particularly if Kevin Hassett is voted in, that is going to result in a weaker dollar. That is going to result in those asset classes doing much better than even in 25, and most of those assets have done incredibly well already. So let's hit global emerging markets first. We are going to hear a lot more about that from Phil Langham from RBC Asset Management in the new year. He runs one of the world's largest global emerging markets funds, so it's going to be really interesting to hear his thoughts about this. But ahead of that, what I think is very important, first of all, as an asset class, it's big. It's 27%. If you look at stock market valuation to GDP on a global basis, global emerging markets account for some 27% of the global equity market. They do carry higher risk. There are liquidity concerns in the marketplace. There are governance issues that we all know about for many, many years. There are currency volatility. The legal foundation is not as set as those in developed markets. But global emerging markets grow faster than developed markets. And that certainly is going to be the case going into next year. And similar to, if you like, the MAG7 concentration effect, we have similar concentrations in global emerging markets, where according to Goldman Sachs, 28% of the global emerging markets index is housed in 10 stocks. Those 10 stocks actually happen to be largely tech related. And they include the likes of TSMC, which is the semiconductor foundry in Taiwan at 11%, Tencent in China at 5%, Samsung at 3.5%, and Alibaba also in China at 3%. Not surprisingly then, tech accounts for almost 30% of global emerging markets, financials at 15%. And this is very different to the way traditionally people have noted emerging markets. You'd always think of emerging markets as largely industrial, capital-intensive, commodity-based economies. In large part they are, but not in a stock market quoted terms. And so when we kind of look at the parallels between developed markets and between our strategy, that I've continuously suggested we should continue to be overweight the US because that's where the technology growth is coming from. And those MAG7, I think, will continue to perform strongly next year. But if you want to have a similar exposure, but without the dollar overhang or headwind, potentially global emerging markets through that technology exposure gives you that, but without the currency headwind effect. So we like that. We like the fact that there is a big exposure within that to China as well. And with that in mind, I think that overall the emerging market story is going to be very much intact going into 26. Let's move very quickly to commodities and gold. We are going to have a very interesting discussion which will come out as an interview later this week with Simon Popple, who's a gold expert. He's going to talk to us about why central banks are buying gold at the fastest pace that they have for many a decade, largely thanks to a diversification away from US dollar and away from buying US treasuries. It is also the one commodity that is going to be an inflation hedge, and that's going to kick in, I think, very strongly in the second half of next year. And this is the reasoning why, despite the strong performance of gold this year, we're probably going to continue to see that seeping into 26 and beyond the first half. It's going to probably be a 26 phenomenon that gold continues to perform strongly. And the wider commodity group is also going to likely perform quite well as well, given that it's not just about the weak dollar that's going to play its part in this performance, but also the fact that the likes of Dr. Copper, the health of the global economy comes through the price of copper, the likes of uranium, are all going to be supply constrained and demand heavy when it comes to data center, AI development, and cloud expansion. All of those commodities play their part. And so I think that this is a highly interesting area. So the conclusion and summary here is that despite the fact that I continue to believe that we have got an expansionary economy, we've got a risk-on environment going into the first half of next year, thanks to a Fed that is effectively dovish, we are likely to see assets, risk assets performing well, all the way from US tech to global emerging markets, gold and commodities. The latter set of assets that we've taken a bit of time to discuss today have got a level of hedge against the US dollar weakness, and that's where I would think about concentrating my attention at the higher end of those asset class ranges that I mentioned earlier. I'll leave it there, and we'll see you all next week. If you've enjoyed this content, please give us a thumbs up and subscribe to our channel. Go to our playlist link below to see the interviews that we've had before and the interviews that are coming up next week, which is with Simon on gold. We've got a very interesting discussion with Jay Rupani on India going into the new year. And as I mentioned in the earlier content, with Phil Langham from RBC Asset Management, who's running one of the biggest global emerging markets funds in the world. Thank you.